We have a lot of excitement and interest in tax-aware long-short SMA strategies because of the power and the flexibility of these strategies. There are three use cases used most often with our clients that I want to take you through quickly. The first is where you have a basket of existing securities. This could be individual stocks, it could be ETFs, or it could be mutual funds, or it could even be a combination of all three. And the use of these strategies can help you diversify and transition a portfolio in a tax-efficient or tax-neutral manner to a given benchmark. The second use case is concentrated positions. With the rise in the Mag 7, we've seen more and more interest from clients who hold a sizable position in NVIDIA, Tesla, or Amazon. And there are very few investment solutions today that are easier to understand and can help you transition a portfolio over a number of years into a diversified basket of securities. And the final use case is capital gains distributions from other parts of the portfolios. This can be a liquidity event where a client sells a business and it has a large capital gain. It can even be from the sale of a house that triggers a capital gain, or from a capital gain distribution from a mutual fund or a private equity fund that you would like to offset in any given tax year. Okay, so this is very important to think about the mechanics of long-short strategies. So typically, when you invest into any investment, if you put $1 in, you have $1 of exposure, what we call gross exposure. With a long-short strategy, you're using margin or leverage to be able to generate more than $1 worth of gross exposure. So I'll use the example of a 145-45 strategy, meaning you're long $145 and short $45. And when you think about that, if you go short $45, then you have additional $45 to invest. So rather than having just $1 of exposure into the market, you can now have $145 of exposure. And putting together the long side of 145 and the short side of 45 or negative 45, you have $100 of exposure. The benefit is because of the power of margin and leverage to be able to generate both exposure on the long and the short side. For that $100 you put into the portfolio, you now have what we call $190 of gross exposure. That means more opportunities to generate potential performance above the benchmark. It also means more opportunities to generate net capital losses that can be used to transition a portfolio or to offset gains from other distributions. So while tax-aware long-short strategies can be a powerful tool in a client's portfolio, it's very important to understand the risks associated with these strategies. The first is, in order to get exposure on both the long and the short side, you're taking on leverage. And this means there's an increased risk from margin on the leverage side. Secondly, there's something we call a tracking error risk. And the goal of all these portfolios is to beat a benchmark. This benchmark could be the Russell 1000 or the Russell 3000. It depends upon the role within your portfolio. But since the goal is to outperform a benchmark, you're going to take on tracking error risk because the managers will try to select securities that will generate a return above that benchmark. And by doing so, you have risks that they underperform in any given year or a subset of years. The level of tracking error risk or variation around a benchmark will depend upon the leverage you select. And in general, the higher leverage strategy, the more tracking error risk that you will take on as a client. The third risk is the cost of unwinding a portfolio. Because you have leverage in the portfolio, it takes more time to unwind or to sell out of both the long and short positions. And so it's really critical that you think of this as a long-term investment. As part of our diligence process, we work with some of the best managers in the tax-aware long-short space. And we spend a lot of time on due diligence, both on their investment process and their operational capabilities to make sure that we can execute and deliver the expectation of these strategies. It's very important when thinking about a tax-aware long-short SMA in your portfolio that you work with your charity partners to advisor to fully understand the risks and how exactly it would fit within your financial plan. Tax-aware long-short SMAs are one part of the toolkit that we have at Cerity Partners when we think about not only your investment portfolio, but how that fits into your larger financial plan. There are additional considerations around tax planning and estate planning, and it's important that any allocation or investment you make into a tax-aware long-short SMA fits within that overall financial plan. Important considerations to work through with your Cerity Partners advisors are the asset allocation, your target mix of stocks, and how a tax-aware long-short SMA can fulfill part of that bucket. The second will be around tax planning for the next tax year and how potentially one of these strategies can help manage your tax bill. And finally, thinking through the estate planning complications, depending upon the structure of your estate and the use of trusts, it's important to think about where to place these tax-aware long-short SMAs within your overall portfolio. Depending upon the risk that you're willing to take and how much in the way of expected net capital losses you're seeking to generate, you can work with your advisor to determine the right amount of leverage. More leverage means more risk. That comes in the form of more margin, as well as more tracking error risk around the benchmark. And it's really important that you work with your advisors to make sure you understand the benefits of potentially taking on more risk, as well as the risk themselves. That comes to us in the form of making sure it fits within your financial plan.